Well, welcome everyone to our interview with Cecilia Cuevas, and I'm so delighted to introduce her and to welcome you to our virtual classroom. Cecilia, I was wondering if you could start by sharing with our listeners a little bit about your background, your work in financial planning, maybe your business model, and the clients you're currently serving.
Sure, thank you. Thank you for having me. I'm excited to be a part of your graduate program and studies in this program. I'm Cecilia Cuevas, and I'm a financial advisor, senior financial advisor with Merrill Lynch. I've been with Merrill for 10 years now, and my primary niche or business model is working with business clients who own their own businesses. I typically meet these clients through their need of financial services for their 401ks. And of course, in exploring the 401k needs of the business, we also examine their cash efficiency to make sure that they're making the most of their available direct deposit cash, as well as their liability management and leasing arrangements. Beyond that, of course, once we get their businesses all set up and their 401ks going and or SEP IRAs or retirement plans, then we look at penetrating the personal assets of the business owner. And typically business owners are very complex. They have a number of and variety of things going on, including philanthropic desires and areas that they support. So we work to help them make sure that they're getting the most of those philanthropic efforts, as well as managing their personal assets to build their personal portfolio and wealth.
One of the questions that I always enjoy asking visitors to the classroom is, what do you think is the major value, you know, the major value that you bring to your clients?
Well, I'd like to think my approach to holistic wealth management. I try to really look at their wealth picture beyond the investment portfolio and look at how we can make their overall wealth successful, whether it's business succession planning, whether it's developing tax strategies to maximize their net gross and, well, their net portfolios, and then of course making sure that their wealth transfer issues are reviewed and met in terms of strategies to maximize the amount of wealth that they can transfer to their heirs and beneficiaries.
Now, this course, as you know, is all about leadership, and we study a lot of different disciplines, consumer finance, social psychology, but I thought it'd be useful for us to start by you maybe describing your leadership style. Is that pretty consistent? Does it change, depending on the situation? How would you describe your leadership?
Well, I think in my approach to provide a holistic wealth outlook view to their overall portfolio, and I don't mean just their investment portfolio, but their overall wealth portfolio, I think that it's really the leadership that I provide is trying to help the client frame their needs. They come to Merrill Lynch with a specific need or goal that they have in mind, and by exploring all areas of their total portfolio or their total wealth, we try to make sure that we provide them a framework, because as you can imagine, someone that has a complex wealth portfolio, they really don't know where to start. It could be overwhelming, just the mere endeavor of trying to get everything together and organized. So what we try to do is, or what I try to do in terms of providing leadership, is give them a framework with which to work and tackle each area of their wealth portfolio one at a time and or logically. In other words, giving them a framework to work in so that they can establish their own goals. We can establish some strategies around those goals and having to meet their needs, and then look at areas of their total portfolio that they may not have considered. As an example, is their trust in order? Have they looked at life insurance? Have they looked at business succession planning? Are they making the most of their tax efficiency strategies? And so in terms of providing leadership, I try to make sure that I approach them initially with the goal of being holistic and not being afraid to share with me everything that they've got going on. Because even if I only manage a small piece of their portfolio, it really has to be integrated and a part of their overall wealth picture. So not only by doing that does it allow me to see exactly what they do have going on, but it also establishes me as a trusted partner or a trusted advisor, meaning that I'm not, although intrinsically I am after everything, I really want to be able to provide total service to the client, and that may mean that I don't necessarily manage all areas of their portfolio. So in terms of leadership, it's being honest with the client, making sure that they know and understand that I'm on their side. I want to provide the most help I possibly can and the most support in meeting their overall wealth outlook and wealth management goals. And by doing that, it offers us the opportunity to build the relationship in a trusted and mutually beneficial way.
Well, Cecilia, we start this course by talking about the family finances. And I was wondering if you could share with the listeners, how do you gather the dynamics of the family as they relate to who's making the financial decisions? How's that being, is it difference between who's looking at the investments versus the day-to-day? How do you gather that information?
Well, really, initially, it's through the initial contact that we have with the clients. In my initial discovery meeting, where we all are introduced to one another, I make it a point to be sure that all relevant partners are involved in the meeting, the first initial meeting. Even if one of the partners predominantly handles the finances of either the business or the family wealth, it's important that all key stakeholders, if you will, in the partnership or in the family are a part of the initial discussion. So in a husband and wife, if the husband's the primary breadwinner, whether he's an executive or a business owner, it's important that the spouse is included in the initial meetings so that we can figure out what those dynamics are and ask the questions that establish who is the lead. Do they have a lead? Do they have a dominant lead? Do they have a true partnership? Or do they both share in their fear or lack of understanding of financial matters and why they seek out financial advice? So it's really at that discovery meeting, and it may take a couple of meetings to establish that, but in the initial meeting, I try very hard to make sure that all relevant partners are there. And I would assume in our discussion tonight that we would relate our examples to a husband and wife that may or may not have a business but are considered high net worth and have several things going on.
We know that something like 7 out of 10 widows tend to leave the current planner upon the death of the husband. And do you think that, even if one person, let's just say the husband in this case, was making a lot of those decisions, do you think that your outreach to the wife, or again, even to that sort of the quiet partner, if you're reaching out to them, you constantly want to get them involved and at least let them know that you're interested, do you think that is sufficient that they're going to stay with you, or do you have to do something to get them more involved?
You really have to try and keep the partners and the related stakeholders involved from the very onset. Even if they express a desire not to be involved in the day-to-day decisions on what is, for instance, what specific stocks or investments the portfolio is going to hold, it's important that I engage them in the discussions and engage them in the understanding of the instruments that we purchase and or trade. I try very hard for the least dominant partner, or the person that tends to take the background seat or the listening mode. You kind of get people's styles. Some people have a conversation and they generate interest and engagement through questions and answers. Some actually stop and ponder and have to think and absorb what you've told them, and it may take a couple of times. I often ask questions throughout the interview process because it's a dual interview. I tell them a little bit about myself first and my background, my education, how long I've been with the firm, and so on. And then I ask them, tell me a little bit about yourself. Who manages the day-to-day? Who's, who's more involved with the business? Do you have succession plans? Are your family members involved? And kind of do a give and take in the initial meeting. When you start to establish who the more dominant speaker is or who the more dominant personality is, then in order to engage the other, I start asking more questions of that individual. If the more dominant partner tends to take control even after I've asked the other partner the initial questions, then I might say, you know, I'd like to hear from your spouse, or I'd like to hear from your husband or your wife to get an idea of what their comfort level is with all of this stuff, whether it's just the initial portfolio or the overall wealth management goals, because your goals may be different than hers, or her goals may be different than yours, and this might be the first opportunity or one of those rare opportunities to actually talk about it and make some decisions together that we can work on as a team.
We know that communication, with our clients is so important, and now it's part of the CFP topic list, and certainly something we continue to try to improve. And in our study of social psychology, the beliefs, the attitudes, the values of our clients, and we also get into gender and culture. And in our study of gender, of course, this is just generalities. But we've learned that sometimes, or the female client may be very, very concerned about the holistic impact of a decision, of a course of action. Really, really focused maybe on the collaboration with you, with the spouse, in determining how they should move forward. But again, generally speaking, we tend to see that maybe the male client is more focused on a quick, efficient answer and an outcome. And as I think about it, and as we in the classroom have been kind of brainstorming it, I think that could cause some challenges in the classroom. In your meeting with the client, maybe even in respect to expectations of the meeting and how quickly you go through things. And I was just wondering, how do you deal with that when you have perhaps a husband and wife or two partners? Their form of communication, their expectations are very different. Do you take charge? How does that work?
I really do try to take charge in at least setting the expectations for how we're going to measure success. The overall success of the portfolio in his mind might be the year-to-year return, from one calendar point to another, whereas her overall success might be, are we going to be able to live in a certain lifestyle in retirement and also meet the needs of funding our grandchildren's education, for example, or will I be able to buy a new car in 3 years, or will we be able to take that dream vacation? So in the initial exploration of establishing what the goals are for the accounts, we have those discussions, and I ask those questions of each of them. Have you guys talked about this together, and do you have an established goal that you can both agree on? And if not, let's explore what might be the short-term goals, year to year, for instance. He might be interested in, well, if you can achieve a double-digit return year over year, which we know based on the market it's not always possible, that might be his measure. If her measure is having the dream vacation in 2 years, how can we set a fair and reasonable goal and expectation for the measuring of the success of our decisions as a team, but also be able to understand that throughout the process it's going to take a consistent monitoring and review of our projected goals and our projected outcomes. And in addition, continue moving that level of expectation out so that it meets the more longer range goals of, taking that vacation in 3 years or funding the college expenses in 10 years. So it's a continual process, and I explained to the clients very clearly on the onset, this is the beginning of a relationship that I hope to have with you for a long time. And throughout that time, we're going to be in constant communication, if not quarterly, annually, at the very least annually, hopefully much more frequent than that, to make sure that we're meeting the expectations and goals that we've set up for each and every account, and more holistically for the overall, for the ultimate wealth transfer issues that you both want to meet. And that has to be an agreed upon and joint decision. by Mr. and Mrs. Client, and also something that I can with comfort say, you know, I think that's a reasonable expectation. Let's model it. We have tools, modeling tools at in our repertoire that we can use with Monte Carlo simulation that can model out those outcomes to a very substantial degree, you know, 85+% probability of success. So as long as all the inputs are correct, and if all the resources and sources are correct and accurate, that modeling can be very successful. And what that does, that effort or that exercise is actually show, are their goals reasonable? Do they have some level of success, or are their expectations too high? In other words, if they have no savings at this point and they're 40 as a couple, they have their business that's successful and has maybe grown over the last 3 to 5 years, and they expect to retire at age 50 or 55. Is that reasonable? Well, with all the inputs of the numbers that we might have, we can model that out with our tools and say, well, maybe 55 isn't a realistic expectation if you want to live at $100,000 a year in retirement. But if you want to change that desired goal or outcome and tweak it, we can maybe get you there at 60 with a reduced amount, or at 65 with a higher amount. It just depends on the inputs. But making sure that we're communicating with the client that it is about setting expectations and goals and monitoring that progress as we go along so that we can meet them and be realistic about being able to achieve success. I wanted to touch just briefly a little bit, or expand a little bit more upon the widowhood scenario. I've actually had 2 widows, actually 3, 2 that were female and 1 that was male, that presented some interesting challenges and experiences for me as an advisor. I had a widow that was actually quite young, that had a couple of young children, and they were, for the most part, caught off guard. It was an accidental death, and needless to say, even though she had been involved with the initial meetings and the review meetings that we had had, I had these clients for 2 years when he passed, and it was a tragic passing, so it was unexpected. It was difficult for her to come to the realization at the point that we actually met after his death that it was now all of her responsibility, even though she shared in the responsibility of managing the portfolios and being a part of the reviews. Now the weight of the responsibility of having to manage the portfolios going forward was really overwhelming for her. And I just told her that this is a learning process, and I was there to support her as she transitioned through this process, and to take it at little bits at a time. And we were able to provide, through the resources of Merrill, kind of a guide and checklist for the things that she was going to need to do and take steps to complete. As an example, you know, making sure that she knew where all the legal documents were, making sure she was aware of all the accounts that they had, and you know, whether it was with us or other financial institutions, making sure that now her trust and succession planning, if you will, for not only the business but their personal wealth was in place. You know, have they established a new trustee on the family trust who's going to have custodial as well as financial trustee responsibilities of the children if in fact something happened to her. So it was an interesting process, and for her to initially understand that overwhelming feeling that it was too much, but that we could attack it or deal with it in smaller chunks, but still get through the process from beginning to end, was very comforting for her, because she knew that we had a framework for her to work in, and it wasn't going to overwhelm her as much as she initially thought. She knew that there was a lot of work ahead, but I told her we could take it in steps, and we'd complete each task as it's lined out, and just being able to see it in a framework, in a printed framework or on a checklist, was very comforting to her, so that she didn't think she was going to forget something that was vital or important, or that she wasn't going to be able to meet the shared goals that her and her husband had established for the family, because now she was on her own. So I think I helped her a lot by just breaking it up to a point that was manageable, but also providing her a checklist, if you will, of the things that would need to be taken care of, and establishing what things within that task list was more immediate and what could be put off a little bit later and even further down the line. In the case of my older client, where she lost her husband, she was in her 60s. He had always managed all of the finances, even though she had been a part of the meetings, the annual meetings. She wasn't part of the regular, ongoing conversations that he and I had on the active management of the portfolios. So at each annual meeting, I would remind her, I'm here for you if you'd like to learn anything more about the portfolio, if you'd like to have a little more detail about what we're doing, be happy to provide you that support. So because I was always open with her when we did meet, she was very comfortable coming to me and saying, I don't know anything about this stuff. You're going to really need to hold my hand and help me to understand what's going on. Now I know I have to be more involved, and I know that my husband would want me to. So again, being able to be open to the client and establish a relationship with them and form a trust that they know in good times and bad, they're going to have some level of support, or they're going to have a support system in place that will help them get through these very difficult times. And with time, the sense of overwhelmness, if you will, subsides. And with time and appreciating the minor milestones that they meet as well as the major ones, and providing success for those, it gives them more confidence. And as long as we're continuing to talk and have open conversations and dialogue about what they're doing and how they're doing it and whether or not it's actually working towards their desired goal, it provides the client a lot more confidence, self-confidence, as well as I would say enthusiasm towards taking on the responsibility of the management. And some clients decide that they don't want to have active day-to-day, that they want to allow discretion over the account. But just making that decision alone, can be challenging. It can be scary, and letting them know that you are part of their team. You're part of, I'll work with your CPA, I'll work with your attorney to make sure that your three-legged stool of support, if you will, is in place and intact, and that we're here for you as trusted advisors. So it really is providing that safety net through communication and outreach that builds the trust that the client eventually relies upon. In the case of my male client who lost his wife, that was interesting because I hadn't had that experience before, and I think that he was very mechanical in his approach. What do I need to do to transfer ownership of the IRAs? What do I need to do to make sure that the trust is in order? How do I deal with the ownership of the business? Because in that case, it was a 50-50 ownership partner in a business that had at least 10 employees. But he really ran the business, even though there was a shared ownership. And so, again, providing him the support of checklists and framing the different steps that he'd have to take, not only with me as one part of his professional network, but his attorney and his CPA as well, providing them the support of making sure that there's a system in place that can help them get through the more immediate needs, as well as revisit the shared goals that they had established that may no longer be the right thing now moving forward, and then look again at succession planning. Are you planning for your younger children? Are you planning for grandchildren? Are you planning for business partners that you may have to, eventually either buy out or absorb? So it's interesting with each and every individual, and it's as unique as individuals are, but making sure that you make yourself available as an advisor to them in times of crisis, as well as getting them through the initial crisis and letting them know that you'll be there to support them throughout, and then checking in regularly to make sure that they're okay. Not just telling them the numbers look good, or this investment is good, this one isn't. It's really providing the support and understanding that you are their trusted advisor, and they're looking to you for advice, but they're also looking to you for support, and embracing that, being a part of the team.
Clearly, you bring that relationship leadership there. and bring so much value to their lives, helping them through a terrible time. Those stories were great. Let me shift the conversation to back to consumer finance a little bit. We know academics study the idea that people like to maintain a lifestyle, that smoothing of consumption. And to do that, we know we have to save, we have to have some type of budgets, but unfortunately, there's a lot of overspending, keeping up with the Joneses, those pressures that obviously we experience in society. So my question to you is, how do you start that conversation about money with your clients? And maybe specifically, how do you start to have that conversation between um, immediate gratification, consumption today versus deferral or building up of reserves for later? How do you have that conversation and talk about that balance?
Interestingly enough, I use a very simple analogy. The analogy that I like to use is that of a vehicle. When you work and you're an active working adult in Southern California especially, you need a vehicle to get back and forth to work. It's a necessity. And depending upon the type of vehicle that you want to drive and the lifestyle that you want to choose, you have to commit to making a payment on your vehicle. It's not unusual that in the initial stages of building your overall wealth or building your career, that you start out with a junky car or you start out with an economical car. And like our career, we start out with lower salaries than what we ultimately end up with. I look at a vehicle and I let people think about a vehicle and the type of vehicle that they want to drive. The more expensive and more luxurious a vehicle they want to have, the bigger the payment or the bigger the cost. Same with retirement. If they want to live a Prius type retirement, then they would put in a $200 a month commitment to their retirement account. If they want to live a Lexus type retirement, then they would put in the payment of a Lexus somewhere between $400 and $500 per month and make that commitment, just like you would a car. It's a tool. And if they wanted to have a luxurious Bentley type of retirement, then they would have to put in the $1,200 or $1,500 payment for a Bentley that they would to have that type of retirement or that type of vehicle. The more simplistic the analogies and the quicker you can get them to the numbers of what it really does cost to have a retirement lifestyle is I think extremely powerful. I can tell anyone, and because I do a lot of 401k business specifically, when I work with participants in a plan, I tell them, you have to make a commitment to get to work and you need a vehicle to drive it. Well, the same with retirement. If you want to save for, or if you want to have a choice of having the ability to choose retirement or continue working because you have to, you need to make a commitment to your retirement account. And because you're young or not, it depends on who I'm working with, the longer time frame you have to build that retirement asset, the less money you have to put in because you have the value of time. So I try to think of analogies that get them there very quickly. In retirement, your biggest expense is health care because you're no longer getting it provided to you through your employer. So you have to self-insure or use what's available to you through the government. But even through the government, Medicare, for instance, there's always a need for supplemental insurance because it doesn't cover everything. So that's the biggest expense. If you've done everything right, you've paid off your car, you've paid off your home, you have your children have already gone through school, you still have the property insurance or the property taxes on your home and property. You still have licensing requirements for your vehicles. You still have to buy clothing. So I can take a given $3,000 to $4,000 monthly need and expand it out to 12 months, bringing your basic needs to a $40,000 to $50,000 level. You want to retire it at age 65. Your mortality rate is 75 for a male or 77 for a female, 85 as much as 85 or 90. So you take that $50,000 need and multiply it at 65 to 20 or 30 years, they get to the math really quick and understand, planning for 300,000 in retirement is not realistic to even meet the basic needs. You really need to start looking at $500,000 to $1 million to $2 million for a desired lifestyle that's really very ordinary, not extravagant, not world traveler. So I try to build analogies to get them to the math numbers right away. That way they can see the need for making a serious plan. And if I happen to notice, say a couple, and they're either well-dressed or they have designer clothing or they have expensive jewelry or they have, salon-style nails, anything like that, I can pick out one or two things that might be able to say, if you spend $40 a week on nail care, yet you've made the decision that 3% of your weekly income is too much for you to save, then it may require you to look at how you spend your discretionary income, because there has to be a commitment to first income less expenses, less savings equals discretionary income. Unfortunately, in our country, we have the poorest savings rate throughout any developed countries, and most people go from income less expenses straight to discretionary income without the savings portion. So I point out that is part of the asset side of the equation rather than the liability side. So they have to see that savings has to be a part of the equation before they get to discretionary income. In other words, not letting savings fall into the discretionary income category. It has to be a part of what gets you to discretionary income. Otherwise, you don't have the choice. You get to that desired age where you think you should be able to retire, but you don't have the choice anymore because you haven't saved enough throughout your lifetime. And then, of course, we talk about time value of money, and that the longer you have to grow that money and compound it, the more likely you are to have success. So it really does take the commitment right up front to make that decision. And then by choosing what kind of car you want to drive or what kind of retirement you want to have, that establishes the numbers.
You mentioned compounding, and we know it's so powerful, and it's key. Early investing using compounding. What do you do in a situation where the client they think they need to be conservative in terms of risk tolerance, and based on their situation, their need, their time horizon, a conservative investment allocation is really not appropriate, and you're not going to be able to take advantage of compounding the way you could. How do you lead the client to a more appropriate risk tolerance level?
I look to and use mortality rates. Interestingly enough, females tend to be more conservative in their approach than males do, and I think it's because males do like to see that year-over-year performance number. That's where they measure success. But with the females, given the fact that their mortality rates are much longer than that of males, it could be as far as 10, 15 to 20 years in some cases. I tell my female clients that that you have a lot longer time period to fund if you want to actually retire at a fairly young age, say under 65 or even under 70. With healthcare and the progresses that we've made in longevity, it's not unusual for a 60 to 65-year-old to live well into their 80s or even 90s. So with that in mind, I tell them, you have 2/3 of your life building your wealth, and then you can hopefully get to the point in retirement where you have 1/3 of your life to spend it. And that's a big number, depending on your lifestyle need. So in order to get there, if we're starting at halfway through our lifetime, say 30 or 40 years old, the acceleration rate has to be really, really significant in order to make use of the compounding, because the period now that we have to compound is so much smaller. So the way I approach that is to say, you know, it's really a matter of time. It's really a matter of making use of the value that you have of the time that we have now to compound those returns, and take a little bit more risk, because again, we're doing long-term planning. This isn't the approach that we take with providing a more riskier allocation for a female client, or for anyone who's planning for a more extravagant, I shouldn't even say extravagant, a more comfortable retirement lifestyle, really needs to kick it into gear early, so we can take advantage of risk when we don't need the money. You know, just like buying low and selling high, we kind of make the money sweat right up front, and then take it easy as we get closer to that desired retirement age. And that doesn't necessarily mean that in retirement we're going to go to an all fixed income or cash portfolio. We're still going to have to generate growth, but maybe at a less accelerated rate. So I try to point out sooner rather than later we can be a little more aggressive with that. And then lo and behold, you do that approach and they see that you don't have to take that much more risk to get a little bit more return. That it's not as scary as one might think, and they get used to the fact that there is volatility within the portfolio. But again, this is long-term money. You don't necessarily do that with the short-run monies or the accounts that have a tighter liquidity need. You only do that with the longer range investment goals or investment accounts like your retirement accounts, where you can really kick it into gear and not worry about the volatility, because it's not money we're going to use in the next 3 to 5 years. It's money that's more longer range. And that's kind of how I approach it, that we design portfolios that have, again, liquidity needs first in mind and time horizon, and adjust them accordingly. So the regular investment accounts that are taxable, you know, you might not be as aggressive where you're actively trading the account, because obviously you're going to trigger long and short-term gains in those accounts. You are looking for performance, but it doesn't necessarily have to be high risk. And you know, you moderate, you ladder all the different accounts and investment portfolios for each account accordingly.
Cecilia, in transitioning the client to that more assertive allocation, do you find it happens, and I think that's what you're saying, it may happen slowly, where you might get a little bit more aggressive, and as it builds, there's more confidence. Is that what you tend to do, as opposed to try to make that major leap?
Oh, absolutely. You have to go at the client's pace. I mean, you know, I've actually taken scenarios where we've split accounts. We say we have one investment account that has $300,000 in it. If we want to test, for example, what a more aggressive portfolio might be, we might take a portion of that portfolio, a third of it or even a quarter of it, and put it into an active, aggressive portfolio, so that the client becomes comfortable and knowledgeable about how volatility within the portfolio works, how the risk and reward portion of that portfolio works, and see if they can actually sustain it and be comfortable with it given time. It's a process, it's a learning process, and you have to be patient with the client to get them there. As they get more comfortable on how the market works and how they don't need to look at their account every single day, they can look at it at a quarterly basis or a monthly basis, a quarterly basis, or even a semi-annual basis, and know that the program is working, and that we've made adjustments along the way if we've needed to. And then, you know, while preserving the bulk of their account, say the $200,000 or let's see, if we split it up at a quarter, the $250 of the account that's more conservative, they see how each portfolio acts and in return provides them performance. So it's a learning process, and you can't rush the client through. The worst thing that you can do is stick a client in a portfolio that they were against from the very beginning, and they experience a down market, or they experience a longer time frame of poor performance, and then you've turned them off completely, and you'll never be able to get them to even test out or explore other options. You have to move them slowly. And that might take a year to year and a half, but usually no more than that, because they get used to how those types of portfolios work, and then they get comfortable with how much they want to actually put into that type of a vehicle or instrument. And again, IRAs are great for that because you do have a longer time frame on those. You wouldn't do that necessarily with an investment account or a taxable account that they might be needing in the shorter run.
Yeah, thank you for sharing that. I just think that's such a prudent approach. It works on so many different levels. Well, in this final portion of our conversation, Cecilia, I know you're an expert or have a lot of experience in the area of conflict. Inevitably, in working with our clients, there's going to be a time where there's either pushback or conflict between the couple, the partners. And I was wondering, how do you deal with that? How do you facilitate or mediate that conflict? And maybe are there boundaries that you have to set? How do you do all that?
Well, fortunately for me, in my former life, before I came to be a financial advisor, I actually worked in a domestic and sexual violence center and provided crisis intervention counseling. So I can't tell you how many times in my professional career as an advisor I've actually utilized those skills. So, and you mentioned that I was an expert in conflict. I would hope to think I'm actually an expert in conflict resolution. But what I've found, and I have been in a situation where I've had couples who have argued in front of me while they're trying to make a decision. And I think it's really important, just like you wouldn't interrupt a couple on the street that was having an argument unless it got physical, of course. You have to give them the opportunity to say their piece, but if it's clearly not, you can only let it go for so long. In other words, you don't want to set up an environment in your office or wherever you're meeting them, whether it be in their home or in a public place, where they feel that level of disagreement, if it's getting too heated, is acceptable or professional. You want to make sure that you're providing that you're establishing yourself as a professional and that you are providing them professional guidance. Therefore, in that situation, say they have an initial back and forth, and you can either feel or hear the tension in their voice. And what I've done in situations like that is say, look, I think it's time that we take a little break and we step back and we reestablish what the real point of the discussion is. What is your perceived goal? And then you can tell me, other person, what is your perceived goal? So let's say John and Mary are having a disagreement, and I would just preface it to say, we're all here trying to achieve a united goal and establish what that goal is. We obviously have to hear one another to see what our concerns are, and then see how we might be able to facilitate meeting those concerns. So if you can each share with me, not with necessarily each other, but share with me what your goal or desired outcome is, maybe I can provide you a solution that might meet or somehow compromise both of your desired goals, and see what we can do with that. And remember that this is a joint effort. So I'm here to provide you possible solutions. You're here to give me you're here to tell me what your desired goals and needs are, and I'm here to try and facilitate a solution to those needs. But they do have to be shared, since this is a household or family endeavor. So if we can approach it that way, being respectful of each other's abilities to speak their mind freely and establish what their goals are, then we can go from there. So it's a delicate balance. I mean, you have to be respectful of the fact that they are a husband and wife and they have freedoms within that relationship, but you also have to maintain that they're in a professional environment and they've come seeking your advice as a professional, and you're not going to engage or allow them to engage in abusive or disrespectful behavior. And so if in fact they become abusive and or disrespectful, that has to be immediately put to stop. And just say, wait a minute, it's getting a little too heated. We need to take a break. Can I get you either one of you some water? Would you like to take a restroom break? Would you like to step outside? Let's reorganize and reprioritize why we're here today, and allow me to help you both reach an agreement that you can both live with, because that's what I'm here for, to help you provide you solutions. And then they can catch themselves at how silly they might be behaving, or how inappropriate they might be behaving, and they typically stop right away. But the dynamics between a husband and wife, as you know, can be filled with spark. It's just trying to capture the passion and make sure that everybody's being respectful in their behavior, but not to belittle the fact that the passion is underlined with the real heartfelt goal of wanting to achieve whatever they want to achieve. So it's just trying to shine a positive light on behavior that may not be completely respectful or positive.
Yeah, I think that's some wonderful insights here, and clearly you've communicated you're in command of the room, that you're that voice of reason. I really enjoyed your comment there about let's just take a break, let's regroup and come back and do this. I'm delighted to announce to the listeners that Cecilia very recently obtained the designation of Certified Divorce Financial Analyst. And this is a big deal, big deal. Cecilia, in that study, and I know that's a lot of study to get that designation, was there any of the content in that helped you or will help you moving forward as you have to deal with conflict with your clients?
Yeah, interestingly enough, the CDFA has its own code of conduct, of course, and it's part of the Institute of Divorce Financial Analysts in conducting yourself in what could be very spirited and disruptive situations, recognizing that really. And again, I have to rely on my background that you can't get more personal with people than their money. Money is a very personal and private and intimate thing, and you have to be respectful of the fact that everybody approaches money in a different way, but it is very personal to each and every individual. I haven't come across any individual that's very nonchalant about their money. Most folks are very private. In a lot of cases, intimate partners don't even know all the intimate details of the finances of the home. You typically have one person who has more information or knowledge than the other, and it's not unusual that there are imbalances in either the engagement of the finances, the management of the finances, or the decision-making around the finances. So in recognizing that, certainly my training with the CDFA designation and what I garnered from the Institute of Divorce Financial Analysts is that first and foremost, you're dealing with a very personal and private event, life-changing event for a family. And you have to recognize that and recognize that it's a very delicate time and a very painful time. And sometimes when people get angry with one another, they tend to forget that these were actually individuals that they loved at some point and cherished and built a life with. If you can somehow relate that or remind them that you're not trying to keep money from your former spouse to hurt them, because ultimately they may be caring for your children. You want to make sure that you try to be as fair and equitable with this person that you chose to build a life with and is now no longer working. So if you can remind them that these were at one time loving relationships, and you built a future and a home and assets and a life together, that I would think, and this is how I approach it, I might say to the client, I would think you really don't want to hurt them. You've been hurt yourself. Let's try to make sure that neither one of you pay more to taxes or pay more to attorneys than you do to one another. And the shared and common goal should be to make each other okay so that each one of you can go on and live productive and healthy lives with others as well as with each other, because most usually divorced couples still have some form of contact or relationship beyond the divorce, and you want to try and provide an environment that is cooperative and amicable as much as possible so that they can have a healthier relationship than when they were in the marriage.
Well, Cecilia, thank you so much for joining us in this conversation and entertaining so many of my questions about content, which I think is so relevant to the content we've been studying, the social psychology of leadership course. But before we end, I just wanted to ask you, are there any other insights, anything you've thought about over the last 50 minutes or so that you would like to share as we end our conversation?
I guess it would just be to remember that the people that you work with, they're human beings, and there's no easier or greater way to connect with a human being than to relate them to an experience that you might have had in the past or that they might have had. Storytelling is a big part of what we do. You know, when you can describe for a client a similar situation or a similar experience to theirs that you've already dealt with, because you're dealing with a lot of people in a lot of different situations that, you know, mimic or mirror the clients that you're working with. So it's not going to be unusual that you can't pull from your own hat of experiences something that is like what you're currently working with the client that you're working with is going through. So if you can somehow relate a story to their situation that you've had experience with where the outcomes have either been positive or negative given one decision or another, you might actually be able to help your client to make a positive decision for their own outcomes. And be personable with them, because they are people. If you care more about these people that you work with than how much you make or the commission that you're going to get from whatever it is that you're doing for them, that's what's going to make you successful in your practice, because people know that, they feel it, they trust it, they relate it, and then they refer. So I guess my final words would be a storyteller, be an honest and truthful storyteller, and make your clients feel like you understand what not only do you understand what they've told you, but you're committed to helping them achieve their goal, because a win-win for them is a win-win for you. And ultimately, if you can do that with your clients, you're going to be very successful in your practice.
Well said. Wonderful conclusion to a most interesting talk. Well, with that, everyone, I'll be bringing this conversation to a close, and I know that you've enjoyed it as much as I did. Thank you, Cecilia.
My
See you
pleasure.
soon.